U.S. economy is slowing as inflation remains just a little too high for comfort. The Fed is meeting right now to decide what to do about it. I'm Jay Sapsford. Welcome to the call. Weak job numbers suggest the Fed will vote to cut rates, but cut too much, and the central bank risks driving up the cost of living. Policymakers around the world will be watching, not just for the expected modest rate cut this week, they'll be watching for answers to the questions for the months ahead. Can the Fed revive growth while keeping inflation in check? Joining us now is Loretta Mester, former president and CEO of the Federal Reserve Bank of Cleveland. She's now a professor of finance at Wharton and a senior scholar at Princeton. Loretta, welcome to the call.
Thanks very much for having me, Jay.
Loretta, here's what the Financial Times said over the weekend. The American industries most exposed to trade turmoil have slammed the brakes on hiring and in many cases begun to lay off workers, causing growth in the U.S. labor market to grind to a halt. Given that sort of report and the weak job numbers recently, is it pretty much given that we'll have at least a modest rate cut?
Well, I do think that the Fed will go through with a 25 basis point rate cut. And actually, at the meeting, I do think they'll actually discuss a case for a 50 basis point cut. And that's based on what we've seen in the employment reports over the past couple of months and the revisions to that employment report. But remember, the Fed has to balance both the maximum employment part of its mandate with the inflation part of the mandate. And as you said, inflation remains too high. It's been above the 2% target for over 4 years. It's about 3% now, which I think is more than just a little bit above 2%. And so the Fed's going to have to balance those goals and take into account the risks to achieving them as they go forward. And so I think there's a good case, I think, to take a 25 basis point cut as insurance against downside risk to growth, but also you want to make sure that you maintain some restrictiveness in your monetary policy to put downward pressure on inflation. And that's going to be the balancing act they're going to have to do throughout the rest of the year and into next year.
Okay, the Fed minutes show that in the past you've argued against premature rate cuts. Would it be premature for the Fed now to do something more than 25 basis points? Is that what I'm hearing you saying?
Yeah, I think it would have be a little bit leaning into one possible scenario. So the scenario that, the underlying narrative has been, aside from tariff-induced increases in prices, the rest of inflation is coming down towards 2%, and the tariff-induced prices are going to be one of increases in price levels. It may take some time for that to feed through to the inflation measures, but once they feed through, inflation will move back down. So that could be what happens, that, tariffs are one ofs, but I'm a little less sanguine, and I think that the Fed should take into account other possible scenarios. So for example, if it does take a while for firms to begin passing through the tariff-induced increases in their costs to consumers, that becomes more likely that consumers, having experienced really high inflation during the post-pandemic period, might say, oh, wow, we've got an inflation problem again. And so that can embed in sort of the decisions they're making. And that's exactly what you don't want to have happening to both businesses and to consumers and workers. You want them to sort of not have to think about inflation, but they will begin to think about inflation if it lingers too long and the Fed isn't responsive to that. So again, the logic that tariffs are one ofs could be, but there are other scenarios, and a lot of what monetary policy making is about scenario planning and risk management. And so I think that's something they're going to have to be considering as they go forward.
Now, Loretta, earlier this year, the big fear was that the tariffs were going to drive inflation by raising costs for consumers and business through imports and that sort of thing. But let me show you a fascinating chart. This is the cost of a haircut. You'll see from the blue line that the cost of getting your ears lowered is still rising well over 3% year on year. Now that's off the highs, but much higher than the Fed's target inflation rate of 2% that you mentioned earlier. And that's represented by the red line you see there. Now this is also true of most services across the economy. So if tariffs don't affect haircuts or other services, doesn't this mean that we have a broader inflation problem beyond the trade turmoil?
Well, I agree with you that, one of the measures that I look at is, core services. So take out food and energy. look at services, and then we know housing is declining. So look at services X housing. And that in the last couple of inflation reports didn't move down as the narrative would suggest, and inflation is on its way back to 2%. It actually moved up and is proving to be very sticky. So I agree with you that that has to be a concern of the Fed. Now, although not of haircuts, I don't think, but some businesses, right? Some of the service price increases could still be tariff related, because what a business is going to do, of course, is look at all the things that they produce. And for things that they think they have pricing power, can raise prices and have it be accepted, they may raise those prices, even if it's not a tariffed good, in order to compensate for goods where they feel they can't raise the price to cover the tariff. So it's too early to know how much is necessarily tariff related, but it does give me pause. And I think it should give the FOMC, the Federal Open Market Committee policymakers pause that, every time they get another inflation report where they don't see inflation X tariffs as much as they can estimate that going down, they have to be concerned that, we can't just get back to neutral if we really want to get inflation back to 2%. So that's the balancing they're going to have to do going forward. Of course, maximum employment is also part of their mandate. And so they're going to have to balance that. And the weakness we've seen over the past, several reports and the downward revisions do show that there's a softening in the labor market, but there's also a softening supply, as you pointed out. And if you look at the parts of the industry sectors like manufacturing and wholesale trade and construction, the supply of those workers and the weakness there is being driven by trade and immigration policy. And so that's not something that the Fed can really do much about. It's supply versus demand. And so that balance between supply and demand could easily happen at a much lower, and I suspect it will, much lower monthly payroll job growth than we've been accustomed to, because supply is falling at the same time demand is falling.
Well, clearly, how businesses are going to react to both trade and immigration policies are front and center here. We've got a couple of questions in from our members, one of which here touches on this notion of tariffs driving inflation. Kevin Warsh, which is the predecessor of yours on the FOMC, says that the Fed shouldn't concern itself with tariffs because it's a one-time business adjustment and thus outside the scope of the Fed. What is Ms. Mester's reaction to that argument?
So that's the main way people are thinking about tariffs. They're a tax similar to a supply shock. Changing interest rates doesn't do much about that. But it is up to the Fed to make sure that one of price increases due to tariffs don't become more persistent inflation. And that could happen if, again, both workers and consumers and businesses start to say, okay, I can pass on a lot of these cost increases and there isn't pushback. And that makes expectations of inflation go up. That can produce this kind of more persistence in the inflation numbers. And that's something that the Fed will have to do. Remember, during the post-pandemic period, the story was supply shocks are one-ofs. It's going to be transitory inflation.
Right.
And we don't really need to worry about it. The Fed should look through it. And as we saw, that didn't turn out to be the scenario that played out. We had an inflation problem. We had inflation readings going up to levels we hadn't seen in 40 years. And that's why it was important for the Fed to raise interest rates. It's up to the Fed to bring demand into balance with supply. And if supply is being cut and is restricted like it was during the post-pandemic period, then the Fed has to act on the demand side to get them into better balance. That could happen this time. And that's what the Fed has got to be very careful about, keeping demand and supply in balance so that we don't get a more persistent inflation problem.
Well, this notion of balancing is really tricky. Congress has given the Fed two jobs, the dual mandate. You want to promote employment and keep prices stable, but it seems like tariffs are by raising input costs and now hurting possible employment decisions, it's really posing a challenge to both sides of that mandate. How do you manage for that if you're one of the 12 people in the room, as you were?
Well, that's what you have to do is you have to sort of make a best, forecast you can. And part of that is really important. I have to point out that your members, a lot of them participate with providing the regional reserve banks of the Federal Reserve information. And, when I was president of the Cleveland Fed, that was one of the highlights of being able to actually interact and get reconnaissance from people who were actually doing the work of, hiring people and making products and facing the supply chain problems. So I want to commend your members for the work they're doing to sort of support the Fed policymaking. But again, a lot of it's going to be, about our firms, and we see this already if you read the Beige Books, which is a compendium of a lot of that reconnaissance that the Fed collects. Firms have said, I need to protect my margin, and I'm going to have to be very careful about my hiring. And so while we don't see at this point a lot of layoffs, we don't see much hiring either. And that is not really a healthy labor market, I would say. And I think that Chair Powell in his Jackson Hole speech said there's a curious balance, between supply and demand. I would say it's an uneasy balance. And that's the issue. Will it become really a point where firms feel that they're so constrained on their margins that they'll have to start laying off workers? On the other hand, they've done a lot of automation throughout the pandemic and post-pandemic period. And now that is also enabling them to maintain margins without having to hire a lot of people. And that should play out over time as well as more firms use AI and other kinds of technology to allow them to maintain margins or at least not be hurt as much by the higher tariffs.
So, talking about the labor market here, I'd like to focus on a report that came out just recently from the Congressional Budget Office that really didn't get a lot of attention. It revised its 2025 net immigration forecast. This is from one of our members is pointing this out. Revised the net immigration down to 400,000 for this year, which is down from a 2 million forecast at the beginning of the year. This is coming from increased enforcement and other policies that the administration is now putting into action. Won't reduced immigration tighten labor supply and offset job losses, at least in part?
Well, that's exactly what seems to be happening, right? So while firms have not been hiring, right, we haven't seen a big increase in the unemployment rate. And that's because at the same time we have much softer demand for labor, we also have supply that's less. So immigration played a big role in increasing the labor force, which when the Fed was doing the increases that we had to do to get inflation down, there was real fear that that was really going to harm the labor market. And it turned out that the immigration that was coming into the country helped to keep the labor market working.
Hmm.
Now we're in the opposite case where we have a constrained supply of labor. And, I think your questioner is correct in saying that that should help mitigate some of the increase in the unemployment rate. And I think that's right. But I would also submit that a labor market that seems to be in stasis is not really what I would call a healthy labor market. We kind of want a labor market where people move in and out of jobs, that firms don't feel they have to be so focused on making sure they don't hire one extra person or two extra people because they have to worry about their margins. And so we're in I would say, an uneasy balance right now. And I think that will continue, but we may see the unemployment rate tick up. And I think the Fed is concerned that if it does start to move up, it can move up more quickly than we might prefer it to do and really cause some damage in the labor market. Many forecasters do not predict that's going to happen, but it's something the Fed's going to have to keep an eye on as it goes forth and balances. My feeling is they're going to be focused on that, but I hope they don't lose focus on the fact that we're still at 3% inflation, and they have to, not just accept that and acquiesce to that, because that's much higher than what's good for a healthy economy.
Well, this raises the prospect, this uneasy balance that you mentioned, raises the prospect of the S word, stagflation. And I'm wondering, we're talking about weak growth combined with inflation. Are we experiencing that now to some extent? And if so, how should the Fed be managing that going forward?
Yeah, I wouldn't say that we're in a stagflation environment, because if you look at sort of the GDP numbers and the growth numbers, they haven't been that bad at all. In fact, that's the surprising thing about the economy, is how resilient it's been, even though there's uncertainty over tariffs and, other costs of doing business. So, that's remarkable. We got retail sales numbers this morning, which, even if you adjust, they were very strong. Of course, some of that's inflation, but even if you adjust for inflation, you can see that consumers did spend, they've been spending over the last couple of months. So we're not in an environment where I think we have to worry about recession at this point. But I do, and I also think that next year you're going to see the consumer being buoyed, because they're going to have bigger tax refunds than they expect because of the bill that got passed. So again, there's a lot of support for the economy. The investment that firms are being made now in data centers, is helping commercial real estate, AI investments. So there's a lot going on in the economy that are positive things. But the Fed has to sort of look at the dual mandate goals. So again, some of that extra growth that we expect next year, the pickup in growth after a soft pass this year, could also be inflationary. So again, keeping your eyes on both part of the mandate as we work through this tariff adjustment is going to be key.
As a final takeaway, what's the one risk over the medium term you think markets and business leaders are underpricing right now?
Well, being a Fed person, am very discouraged by the attacks on Fed independence. And, the Fed makes mistakes. We should have raised interest rates faster than we did, in the post-pandemic period, or earlier than we did, so that we might not have to go as fast as we did. And there's lots of things that we could do differently, but fundamentally, the Fed has delivered a good economy over many, many years, and partly that's because its policymakers are actually able to focus on achieving its mandated goals that Congress gave it, independently from any kind of political considerations. And that's under some stress right now. And country after country has shown that when you take away that independent policymaking ability of the central bank to set monetary policy, you end up with worse outcomes for for their public. In the US, if we were to step back from that, the American public is the one that's going to be hurt. We're going to end up with higher inflation, less stable prices, and you won't, have a good, vibrant economy. So again, country after country has moved towards more independence of their central bank because it delivers, doesn't cost you on growth, and delivers better inflation and price stability. And yet in the US, that's under threat. And I think that's a danger. And it won't produce lower long-term interest rates. It'll actually add a risk premium for inflation into those long-term interest rates. So it won't even deliver what the president says his goal is, which is lower interest rates.
Well, ever since Nixon took us off the gold standard in 1971, it's the 12 people in the room that have, in their independence, that has kept a sound monetary policy and supported the dollar over all these years, and been such a contribution to the global economy. We appreciate your service in that matter. Laura Mester, former president and CEO of the Cleveland Fed. We really appreciate you swinging by today. Thank you so much for your insights.
Thank you.
All right, our audience has gotten their shot of informational espresso and is ready to tackle the day. If you've missed a live episode, you can catch the replay on our website, LinkedIn, or on YouTube. You can also listen to the call's podcast edition on Apple, Spotify, or wherever you get your podcasts. Thank you to our members for joining us today. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.